Good evening, welcome to this week's India Market Weekly Outlook. We are covering global macro, domestic triggers, market psychology, trading zones, and a watch list, so you finish with a clear plan for next week, not noise. Global markets, weekly wrap, US, Europe, Asia. This week global markets delivered a cautiously optimistic tone. In the US, some weakness in bond yields and softening dollar sentiment supported risk assets. That helped equities rally slightly, especially in growth and tech-heavy indexes. In Europe, markets were mixed. Cyclicals and exporters got modest support, but economic data remains uneven, keeping investors cautious. In Asia, markets were broadly range-bound. Some markets saw gains on global cues, others remained cautious due to regional demand concerns and currency volatility. For India, this global backdrop matters. When global risk sentiment is positive, with stable yields, softer dollar, and stable commodities, emerging markets like India tend to benefit. Conversely, any global surprise, hawkish central bank tone, rising yields, sharp commodity moves, could rattle sentiment. As of now, global investors seem willing to give risk assets another look, which means foreign flows might gradually return if domestic conditions hold up. In sum, globally, risk-on is back, but cautiously. For Indian markets, that means the environment is neutral to positive, not breakout bullish just yet. Dollar index, bond yields and volatility, what it means for India. One of the most important invisible levers for Indian markets is the dollar and global bond yields. Historically, a strong dollar or rising global yields tends to weigh on emerging markets like India. Foreign investors often prefer safe haven assets, and currency headwinds add to repatriation costs. This week, signals suggest the dollar cooled off slightly and global yields remained relatively stable. That's a supportive backdrop for equities. A softer dollar boosts rupee-converted returns for foreign investors and improves outlook for exporters. Lower yields, or stable yields, mean less pressure on interest-sensitive sectors, lower funding costs, and a more friendly environment for growth names. Volatility globally appears somewhat contained too, fewer wild swings, more measured moves. For India, that reduces the risk of sudden foreign outflows or knee-jerk reactions. This sets the stage for gradual accumulation rather than frantic rallies, provided domestic triggers behave. In short, dollar and yield dynamics, key macro levers, are currently favorable. That gives markets breathing space. Crude oil and gold, weekly influence on Indian equities. Global crude price and gold continue to be major external forces influencing India's economy and equity markets. Import dependence means oil swings impact inflation, cost structures, and corporate margins. This week, crude remained stable to mildly soft, easing some pressure on imported inflation. That's good for sectors sensitive to fuel costs, like transportation, logistics, airlines, and for consumption, since lower fuel reduces cost push in general. For refiners and oil-dependent industrials, this provides some margin comfort. Gold, meanwhile, maintained demand as a safe haven, a mild risk-off hedge globally. While that usually signals some risk aversion, as long as crude and yields stay stable, equity investors might treat gold strength as a diversification buffer rather than a signal of impending sell-off. So, stable to soft crude plus stable global yields plus contained volatility is equal to a supportive macro backdrop. If this remains, cyclical and consumption names, plus exporters, could see selective strength next week. But watch out, any sudden crude rebound, geopolitics, supply issues, or dollar yield shock could quickly revive inflation and risk premia, which could pressure interest rate-sensitive sectors and overall market sentiment. Domestic indices, Nifty 50 and BankNifty, weekly analysis, long-term zones and tradable levels. Let's now turn to domestic markets, the heart of what you trade or invest in. At weekend, Nifty held firm around the mid-26,000 zone, showing consolidation after recent strength. According to technical strategists, while the recent surge and a rate cut-driven bounce helped, weekly charts show a negative closing, meaning this week was more about digestion than explosive breakout. Long-term structural zones to monitor closely. For Nifty, the structural support demand zone lies around 25,600 to 25,900. As long as the index stays above this band, the broader uptrend remains intact. On the upside, a structural resistance or supply zone lies around 26,800 to 27,300, a zone where profit-taking and consolidation often occurs after strong rallies. Weekly support and resistance, practical tradable levels. Support, ~25,900, near term, then 25,600, major structural. Resistance, ~26,500 to 26,800, then 27,200 to 27,300. For BankNifty, analysts note that the index is trading in a rising channel and currently holding support after the recent dip, which keeps the setup neutral to positive for now. BankNifty's possible structure, a support band around 58,800 to 59,200, which if held, keeps medium-term bullish bias alive. On upside, a breakout may target 60,000 to 61,500 depending on momentum and macro flows. Interpretation of weekly chart behavior. On weekly charts, the consolidation suggests markets are digesting recent gains rather than distributing, no sharp reversal signs yet. On daily intraday charts, oscillation within the range suggests rotation among sectors and some indecision. That structure favors a dual approach, disciplined swing trades using long-term zones, and tactical trades using near-term support resistance, depending on global cues. My view for next week, bias remains cautiously bullish, provided Nifty holds above ~25,900 and BankNifty stays above ~59,000. But any macro shock or liquidity disruption could turn the tone neutral or negative quickly. Sector rotation, who led versus who lagged, this week. Given the macro backdrop, stable crude, steady yields, neutral dollar, sectors saw selective rotation. Leaders this week, financials, banks and NBFCs, large-cap quality names, and parts of industrial capital goods space. This reflects optimism on interest rate easing, liquidity infusion and domestic credit growth. Global brokerage optimism about India, see below, adds further comfort for quality, large-cap plays. Underperformers laggards, highly leveraged mid-caps, small-caps, and commodity-linked sectors, especially metals and resource-heavy names. Weak commodity prices meant limited interest in commodities. Meanwhile, energy refining remained muted because of stable crude, which lowered urgency for speculative flows. Watch out, if crude or global commodity prices spike, or global volatility returns, defensive sectors, consumer staples, utilities, gold-linked, low-beta names may see rotation in. Overall, the current economic and macro setup favors quality cyclicals plus stable large caps plus financials, rather than aggressive commodity or small cap plays. Institutional flows, FII DII activity, cash plus derivatives, and what it implies. This week, institutional activity was nuanced. On one hand, foreign institutional investors, FIIs, remained somewhat cautious, not aggressively buying but not exiting en masse either. On the other hand, domestic institutional investors, DIIs, showed selective accumulation, especially in large-cap, stable names. That kind of flow profile suggests rotation rather than panic, a healthy sign for overall market stability. Analysts are watching closely. A clear return of FII flows could be the trigger for the next leg up, but until that happens, expect modest moves and consolidation. In the derivatives, F&O space, Chatter suggests option open interest and strike-wise pain zones could create pinning around key index levels. That means we may see Nifty or BankNifty hover near support resistance, shifting only on strong macro or flow triggers. For traders, institutional flow stability plus macro clarity is equal to a period where disciplined trades, not speculation, are rewarded. For investors, this may be a good window for measured accumulation in quality names. Key macro and domestic events to watch next week, trigger watchlist. A few key triggers next week could shape market direction. Monetary and liquidity cues. After the recent rate cut by Reserve Bank of India, RBI, and signals of liquidity infusions, markets will keenly watch for follow-through, bond yields, credit growth numbers, banking sector commentary. Global cues. US rate cycle commentary, global bond yields, dollar strength weakness, and any macro surprises. These will influence foreign flows into Indian markets. Given the global sensitivity, markets can move sharply on such cues. Commodity and currency movements, crude oil, global commodities, and rupee volatility, all can influence inflation, input costs, corporate margins, and investor sentiment quickly. Watch for sharp moves there. Corporate results and earnings season, large-cap banks, financials, industrials, exporters. Upcoming quarterly results could drive sector-level rotation depending on guidance and margin outlook. Macro data, industrial production, inflation data, trade deficit numbers. Any sign of slowdown or inflation could affect interest rate expectations and equity valuations. In short, next week's direction depends less on domestic retail appetite and more on macro, global flows, commodities and liquidity, which makes it vital to watch headlines and flows, not just charts. Market psychology and expected behavior, coming week. Given the backdrop and flows, here's how market psychology likely plays out in short to medium term. Traders and smart money, likely to remain cautious but opportunistic, buying selectively near structural support zones, especially in high-quality, low-volatility names. Retail investors may wait for clear breakout or strong news trigger, less likely to chase rallies given recent volatility and elevated valuations. Institutions may slowly accumulate but remain sensitive to overseas cues, not yet in full swing, but readiness to deploy if flows turn favorable. Volatility and risk, likely to remain moderate, sharp moves only on global commodity surprises or geopolitical macro shocks. Otherwise expect consolidation, range-bound movement. Overall, the mood is selective optimism. Not euphoric, but not fearful. That makes it a phase where discipline and macro-awareness matter more than bullish conviction. Watchlist: 3 to 5 stocks to monitor, educational perspective only. Given the macro, flow, technical and sector backdrop, here are some categories and example ideas to keep on radar. Use these as watch ideas, not as stock tips. Always manage position size and risk conservatively. Large cap private bank financial institution. Rationale: with rate cuts and liquidity infusion, banks may get a boost from improved credit growth, lower funding costs, and better loan demand. Banking and financials are also large weight constituents. A run here can drive broader indices. Risk management: use support zones for entry, avoid oversizing given volatility, track interest rate outlook and global flows. Export-oriented IT tech services company. Rationale: a softer stable dollar plus stable global demand can improve margins and order book visibility. Exports get rupee benefit when dollar stabilize, and global risk appetite helps tech valuations. Watch for any global demand slowdown or rupee depreciation, which could affect margins. Refining downstream oil and gas energy name. Rationale: with crude stable or soft, refiners' input costs remain manageable. Demand side may improve if economy stays stable. Lower crude helps reduce imported fuel cost, benefit margins for downstream energy and consumption-linked sectors. Risk: crude price rebound, currency depreciation, global demand slowdown. Use tight stops. Mid-cap industrial with good order book and moderate valuation. Rationale: if economic activity picks up, industrial cyclicals may see upgrade. Exports, infrastructure demand, domestic capex could boost such names. Risk: higher beta, more volatility, global cues and commodity swings may affect them disproportionately. Educational note: for each of these, treat the weekly support resistance zones of indices as structural anchors. Only enter if macro plus flow conditions look stable, and use small allocation with tight risk control. Trade plan: tactical, for next week. Here's a practical, actionable trade framework based on current conditions. If Nifty holds above -25,900 to 25,600 on weekly close, bias remains bullish. Favor swing trades into support zones with targets toward 26,500 to 27,200, keeping risk per trade moderate, 1-2%. If BankNifty holds above -59,000, consider longs, especially in banking financials. Target 60,000 to 61,500, using dips for entry. If either index breaks below structural supports with volume, shift stance to neutral, reduce exposure, avoid greed, wait for reaccumulation or fresh triggers. For individual watchlist names, treat them as tactical or positional plays, use weekly index zones to time entries, and manage position sizing and stops strictly. Keep overall risk under control, avoid overleveraging, especially in high beta or commodity-linked names, diversify across sectors, rather than concentrating. Big picture: why this phase matters. We are in a transitional phase globally, lower volatility, stable yields, soft crude, but geopolitical and global macro uncertainty still looms. For India, that means we are not back to a full-blown bull market yet, but we are moving out of fear-driven consolidation into selective optimism. Institutional flows, global cues, and macro policy, especially liquidity and rates, will dictate the next leg up. For long-term investors, this could be an opportunity to accumulate quality large caps, financials, exporters and cyclicals, provided global stability holds. For traders, this is a phase for disciplined trades, not speculation. For risk-managed participants, this is likely the calm before the next wave, so stay alert, stay diversified. Final thoughts. Global backdrop remains cautiously supportive, stable yields, softer dollar, contained volatility. Domestic indices, Nifty and BankNifty, are consolidating, structure remains intact if support holds. Sector rotation favors quality large caps, financials, and cyclicals, mid-caps and commodity names remain under pressure. Institutional flows are stable to positive, but foreign flows haven't surged yet. Return of FII flows could be the next major trigger. Macro risks, commodity swings, global yields, currency, remain, stay alert. A disciplined, zone-based trade plan with tight risk control is the best way forward. Avoid chasing breakouts, wait for clear triggers.